Got a special episode for people today. I guess you can call it an emergency episode. I am joined by my friend and business partner, Max Wiethe. People watching this may say you're going to talk about the stock market, President Trump, tariffs, China, all of that. Max has been following that. We're going to talk about that in probably 15, 20 minutes. And then later on, how we're positioning out throughout this kind of panic on Wall Street. But Max, I want to start off and talk about credit. So, first of all, Max, hello. How are you?
I'm doing well. My portfolio has done better, but we'll make it through.
Yeah. So I actually, in dollar terms, have today's my biggest loss ever. But it doesn't hurt as much as you'd think it does. But again, we'll talk about that later. I want to talk about credit, but before we do, a reminder to everyone watching that today's episode is brought to you by Fiscal AI, which is the world's fastest growing stock research platform. It's a platform that we use. The charts that you can see on screen are from Fiscal throughout this episode. And if you're a Monetary Matters listener, you can get 15% off any of Fiscal's paid plans with the link in description. Max, I want to start off and talk about credit, because normally when you see stress in credit markets, you see it in the high yield bond market. The old name being the junk market. That market, Max, has been very quiet. And if anything, actually, the high yield market over the past month or so has, like the stock market, gone up, not down. Credit spreads have rallied. But Max, in the non-bank financial world, private credit, there's been two bankruptcies, but really one in particular that has just sent shockwaves throughout that market. So in not in non-bank traded stocks such as the private credit managers, Ares, Apollo, and the like, those are down big time. Blue Owl, Blackstone, those managers, but also the business development companies that are basically leverage credit products, those are down massively. We can show on screen some of them down 5%, 10%, 11%, 12%. In one small one is down 31% since the bankruptcy of this one company, and that company is called First Brands. And Max, this bankruptcy, we didn't think it was that large. Then the losses get bigger, then they get even bigger. And so as we record this in the middle of October, the total liabilities appeared to be $11 billion. What did First Brands do? They were a lender, a factor, and reverse factoring company, basically buying and selling trade receivables. So, Max, if you sell something to a large commercial client, you sign the contract and then are paid in 30 days, 60 days. You then have a receivable. You don't have cash, you have a receivable. You could sell it to me or sell it to First Brands and they get paid immediately. Going back hundreds of years, this practice was called factoring, but it's also called discounting. And so actually the discount window, the Federal Reserve discount window, is kind of a form of that, but in a much more archaic and limited way. So clients of First Brands included Walmart, they included AutoZone, basically many different automobile parts shops throughout the U.S. And Max, the scale of this is quite large. I mean, a $10 billion bankruptcy, they happen, but they're kind of rare, and it's kind of incredible, Max, just uh, how linked up everything is. So I'll just to name a few names. I think the first one that was reported was UBS, the Swiss bank that took over Credit Suisse. They had a 30% exposure through one of their funds. O'Connor. Then it was reported that Jeffries, the large U.S. investment bank, had a $1,715 million exposure through one of its funds, Point Bonita. I'll get into some details there. I actually don't think that the 715 million number is accurate to Jeffries. It's accurate, but not to Jeffries. Blackstone, in one of their funds, had exposure. They sold that from one of their funds, SRLN, at about 35 to 40 cents. BlackRock did not have direct exposure, but they were an investor in one of the funds that Jeffrey managed, and now they're asking for their money. They're asking for their money back. Morgan Stanley, also investor in that same fund, asking for their money back. So there's kind of a dash to receive as much money as he possibly can before this entity is kind of picked at by the vultures in the bankruptcy process. And I mean, there's some stories of $2 billion that lenders thought was there just basically disappearing. So this could be a case of pure fraud, and that could be bad news, Max. It could be good news. The bad news is that I mean that if it's a fraud, you're not getting that money back. The good news that if this is fraud in this instance, that maybe it is not systemic. And I think you're starting to see pricing in markets that have a concern not just about first brands, but a concern about, are there other first brands? Well, we know Tricolor, the subprime auto lender to disproportionately illegal immigrants, that went bankrupt. That was the earlier bankruptcy I referenced, but not nearly as big as first brands. But are there more Tricolors? Are there more first brands? I don't know. I don't think people in the market know, but I think there definitely is a concern that the answer is yes. But if it is just a pure fraud of first brands, and there's this guy who had this business out of Ohio, but he was from Malaysia or spent some time in Malaysia, and he just went on this huge acquisition spree over the past 10 years, and heavily indebted in order to finance that. If he's just a one man band of fraud, then maybe things in the private credit markets are not as bad as some market participants are concerned. But Max, I do have to say, before the Trump truth about China tariffs that kind of sent shockwaves into the stock market, which you're going to talk about later, I was tracking this credit story, and it really is a big sign of concern. And Max, on this show, as well as previous iterations of my show, I talk to a lot of people, who are bearish or worried about a recession, or worried about a credit problem. And I've got to say, Max, basically going back to 2020, this is probably the biggest thing that actually happened. Obviously, people are always afraid, there's going to be some sort of credit event. People throw around the word credit event. In terms of a systemic crisis, this is definitely, so far not that, but this is a big credit event, Max. Very big.
Yeah, I guess my question would be, from what I have read, and you have been, digging into this all day, basically. I heard it was an auto parts manufacturer. Now it seems like they're more of a lender or a borrower, more of a credit company. I mean, where is the tie into auto parts manufacturing?
Oh, they are an automobile parts manufacturing, and they factor mostly against that. So they are, mostly in the uh, automobile zone, and so was Tricolor. So that's a question about, is the auto sector quite weak? A lot of, I mean, Tesla's been trading quite strongly. A lot of auto related stocks are trading quite strongly. And, Carvana, a stock that I actually shorted today, not because I'm some massive bear, but just I was way too positioned on the long side. And I think that Carvana could be caught up. I think, according to Jim Chanos, who has from time to time been short or advised being short Carvana, that over 100% of their profits are from financing. So they don't make money from selling cars; they make money from financing, cars, and lending people money to buy cars, and then selling those loans uh, in the non-bank market. And I actually looked it up today. I think they sell a lot of their loans to Ally, which is a real bank, and publicly traded, so you can look up a lot of their deals, as well as through the securitization market, so asset-backed securities. And a lot of first brands is through the off balance sheet variable interest entity, special purpose vehicle, different words for a similar thing. And Carvana does a lot of that. So I think if there truly is a slowdown, or just kind of the music stops playing in the um, asset backed securities market for motor vehicles, I think Carvana will have a hard time. And I think its valuation already is priced as if it's like as if it's Apple that just discovered the iPhone. And I don't think that it's quite there. So happy to be wrong. Would love to lose money in my Carvana short, and then my rest of my portfolio does better, and the rest of the market does better. But I think that it appears that kind of the eye of the storm, if it is a storm, is in this motor vehicle automobile parts specifically.
So obviously with Tricolor, that's specifically like lending to borrowers who are buying cars. This is a little different. It seems to me like this guy had a business where he was rolling up auto parts manufacturers, right? So he's taking on debt to buy these auto parts manufacturers. Then he's actually selling auto parts to places like Walmart, AutoZone, etc. And then he's getting these invoice receivables from them, and then instead of getting the cash, he has these loans that he has to pay off. He has to pay them off quickly, and he needs the money now. So he's going out and selling, doing the factoring to get cash in hand faster. But it looks like he might actually have been selling these same invoices to multiple parties, and that's why things have ballooned so much. Is that there was Ponzi like qualities to what was happening here?
That's exactly right, Max. And yeah, again, it was almost exclusively within the auto and auto parts supply chain. But yeah, it was mostly factors. So on the one hand, making a loan to the supplier of Walmart. On the other hand, um, buying those receivables back and turn them into cash. So I think it is a business model that doesn't invite fraud and misdeeds and financial alchemy of the dark art of the dark art kind, bad wizardry. But it does kind of seem to be associated with it because actually um, Credit Suisse, which was acquired by UBS, which is maybe involved in this mess through his fund O'Connor. Credit Suisse got involved in a bad way with Greensill, which was a factoring and reverse factoring supply chain company that had similar issues and declared bankruptcy. And Greensill is no more. So I don't know if it's just it makes it easier to do fraud, or it's such a commoditized business that if people really want to make money, they can't make money honest way, so they make money doing fraud. I don't know, but there's something going on there, and I do hope that this is limited to this one company or maybe this individual sector. I was going through some of these business development companies that have gone down 10%, and that's for a credit asset, even though these are leveraged companies and they are officially companies, not not
It's the
credits, but they
equity.
own
It's the
credits.
equity. Yeah.
Yeah, yeah. I mean that these are big deal, and I particularly I know the stock market dropped sharply today, but before today, the business development companies had gone down, while the stock market had gone nothing but up, and normally they're very correlated. So that was something I was observing last night. So it's actually interesting today that the stock market dipped today purely for an unrelated reason, the Trump tweet. But Max, I have concerns, but I think that there also could be an opportunity on the long side in these business development companies. I was looking at uh, well, the one of the biggest ones is Ares Capital Corp. I actually think that is the biggest one. And officially, I looked up their exposure to the auto industry. It was 0%. This one of the other big ones that I happen to like, and I actually bought a very small amount of it today, is Main Street Capital Corp. Which again, they these business development companies, they borrow in the wholesale market, and then let's say they borrow at the Fed funds rate plus 2% to buy loans that yield the Fed funds plus 7%. So they are leveraged entities, and some of them also own preferred equities. Some of them own equities outright, and so they do have exposure to private credits and private equity. And I do think everyone talks about the democratization of alternatives, and that is one way to get involved, is just like buy one or several of these things. VanEck actually has a business development ETF that actually, like unsurprisingly, that BDC is actually down about 10% around there. VanEck, of course, being a sponsor, this not being a sponsored episode by VanEck, but just full disclosure there. But they it's an interesting class. I think they're interesting asset class. I think there's a lot of dispersion between the long term performance. Some of them since inception have returned um, well over 1,000% and have beaten the S&P. That's true of Main Street Capital Corp and Ares Capital Corp since inception. Some of them, actually, a lot of them have performed quite badly, and I think that one of the issues for BDCs, business development corps, is that a lot of them are managed by external parties. So let's say, Bax, if you and I had a business development corp, um, and then but we had our own asset management firm that managed it. Uh, we would have an incentive to basically make sure our AUM, our assets under management, would be as big as possible to maximize our fees. So we would kind of always be issuing in the market. We'd be issuing shares, selling every day, creating new shares to buy more loans, even if our share price was selling below net asset value. So I think that can be very dilutive. However, like Main Street Capital Corp, which almost always trades at a premium, has an intrinsic manager. So it doesn't have that incentive issue, maybe nearly as much. And they when they issue, they sell at a premium to net asset value. So that's just one example of how buying the value stock that has the lowest price to book may not actually work. And actually, you want to buy the most overvalued price to book, high net asset value thing. So again, I took a small position in Main Street Capital Corp today. I definitely could be wrong. With the size I'd in, I probably will hold it. Even if it goes down. But in the 2008 type thing, these things just absolutely crapped the bed, and they were nowhere near as big as an asset class as they are now. So certainly, I would get destroyed in any. on any short-term time horizon if we have a 2008 type moment. I don't think that this is. Max, some people are referring to this as a Lehman moment. It definitely could be. I'll say this. It's a Lehman moment for auto supply parts out of Ohio. It is a Lehman moment for that. But for the entire economy, I don't quite think so. And Max, for example, like Norinchukin Bank, a Japanese bank, which is not publicly traded, and then Mitsui, which is a Japanese trading company that I actually think Berkshire Hathaway and Warren Buffett owns. They have a joint venture where they have a 1.7 billion dollars of exposure. I actually haven't looked into that. So it could be that they literally could lose $1.7 billion. It could be that that is this overall size of their fund, and their fund is levered and their equity position is smaller. I don't really know. People should look into that. I will say on this Jeffries point, I don't think Jeffries' true risk is $715 million. Jeffries, quote unquote, owns Lucadia Asset Management, which has a 5.9% interest in this Point Bonita fund. So I think Point Bonita, other people own it, and other people are LPs, and then it's other people. Point Bonita, I think, is a leveraged entity, but Jeffrey's true risk is 5.9% of Point Bonita, and Point Bonita's total risk to First Brands is 750 million. So Goldman did the math, and Financial Times reported it, so we can put it on screen that Jeffrey's true exposure may only be 42 million, which I think they probably make that in net income in a week. Likewise, there was a Nomura, Japanese bank. Financial Times hasn't, I don't think, reported it, or other people. But if you go through the documents, I was just surprised, to learn they have an 8.9 million exposure to what's it called? 100 years ago, $8.9 million would be a lot for a big bank, but it's not now. That's like that's like one day's worth of earnings for Nomura. So I think that the exposures are real to the traditional banking system. Interestingly, there's a guy on Twitter who follows BDCs really closely, and the BDC exposure that he's been able to find is nowhere near what the market is kind of implying in its concern of these BDCs going down 10 to 12 to 14 to 30% in a month. But I guess the concern there is that there are other First Brands, and that these marks are inaccurate. But I would say, like in the traditional banking system, it doesn't appear that the losses are that big. However, Max, if you read, I was not an investor or a financial, someone passionate about finance in 2008 at all. I was too young, but I read a lot of books about 2008, and like this is always what happens in chapter 3 or chapter 4. Is like, oh, the losses aren't that big. Who cares? Let's double down. And I think that maybe as a generation, not just young investors, but all investors have kind of been trained to, whenever there is a moment of risk and a sell-off, they get rewarded by doubling down and buying the dip. And in credit, that's what I did. I had no exposure, and now I have exposure to a business development corp. In equities, I actually de-risked, and we can get into that later. But Max, any other questions before we move on to the stock market, which really is the bigger story for mainstream news today?
No, I think you covered it, Jack.
All right, so Max, what's going on in the stock market today? And I should say, Max, the often on huge one day moves down in the market, we have business meeting that happened in April during Liberation Day, and it happened today. We had a business meeting in Midtown, so we were kind of literally out to lunch until we realized that, wow, the stock market is not having a very good day, is it?
No, it was pretty serendipitous that it happened again. S&P 500 was down 2.7% today on news about Trump's tariff not a tariff tweet. It was more of just a trade war escalation tweet. He was pretty upset by moves that came out of China recently, which I think it's important to take a step back and say what is happening right now. So Trump is scheduled to go to Asia in a month and was supposed to meet with Xi for some high level trade talks. In the run up to that this week, the Chinese have implemented some pretty strict controls around rare earth materials. And it's not just saying, okay, we're not exporting our rare earths anymore. They're also trying to go after foreign production of rare earths because they also control the supply chain for a lot of the equipment that is used to mine and process these rare earths. And they're saying that if you want to use our equipment, you want to use this stuff, you're going to have to go to us to get exports approved, especially if those exports have anything to do with advanced chips or defense. So clearly that is a pretty big deal for Trump. the irony is, of course, that we're kind of doing the same thing with semiconductors and advanced chips, with our own allies. Needless to say, though, it caused some escalation, and it caused a tweet from Trump. Now, the question is, and specifically because he said we are going to retaliate, and for every one element that they control, we have a monopoly on two of them. So
Which I don't know
clearly,
if it's true, but really, yeah, the thing he said at the end of his very, very long post on True Social, he said that one of the policies that we are calculating at this moment is a massive increase of tariffs on Chinese products coming into United States of America. There are many other countermeasures that are likewise under serious consideration. I believe that the 90-day exemption that has kind of been rolling and rolling on Chinese tariffs, so the 90-day pause, I should say, of Chinese tariffs to the super, super, super high level, ends on the middle of November. So next month, I believe November 10th. So there is kind of a 1 month window where Trump does have some bargaining power because this date approaches where levels of Chinese tariffs are going to go up a lot.
yes, exactly. So that is what pushed things over. But obviously, we knew that this date was happening. It's not like there's been so much of a softening of relations between China and the US in the meantime. I mean, he's definitely been picking on like India a lot. So perhaps people have just kind of forgotten about it. But I think it has more to do with what has been happening in the market, right? Like everybody has been talking about the way the market has been pushed higher by many of these like circular financing deals in the chips market, which I know we're going to talk about after this. So I think there was a lot more to do with just everybody is crazy long right now. And that aspect of positioning more so than we got concrete news about a policy that people are worried about. I mean, people have known about this, and the market has really kind of shrugged it off. And look, if you zoom out even further and you look at the year, it's not a huge drop in the market, but what we saw today essentially erased a month worth of gains. If you go back a month, that's what has been wiped away. But obviously, with this being about rare earths, one of the companies that rallied today was MP Materials. So MP Materials being the largest producer of rare earth materials, minerals outside of China, and it being a publicly traded company. Jack, I know you've actually interviewed the CEO of the company before.
5 years
Um,
ago, yeah.
yeah, it's been a while. I mean, that was when it first came out. I think did it IPO or was it a SPAC?
It was a SPAC, I believe, a SPAC, or help orchestrated by Chamath Palihapitiya, actually. Yeah,
Yeah. So at the time you interviewed them, it was private, right?
I think it had just SPACed. Yeah,
Just SPACed. But I think it's interesting that the stock was up 8-10% on this. Interestingly enough, MP Materials is a member of a very exclusive group of stocks, which I think are interesting to look at. It is a member of the group of 4 companies that the US government holds equity in. I think we all heard about the Intel deal where the US government took equity. As well, there's a lithium company, ticker LAC, and then another one that is it's Trilogy
Trilogy
Metals.
Metals. Yeah,
Yeah, Trilogy Metals, which I know you've also owned in the past.
yeah.
And that one is very recent. They just had a deal come out on October 6th. But one of the interesting things about this group is they have all performed very well, either since a deal has been officially announced or since rumors of a deal have been announced. It's a major trend. They all have been around resources, or you could argue that semiconductors are a commodity as well. That the supply is critically important for defense, and for technology here in the United States. So similar company, in that way. There's another one that some people are including, which is U.S. Steel, which the U.S. government doesn't necessarily own equity in the same stake. They have this golden share veto rights, which
Mm.
basically is anything, because the Japanese bought it. And to get the deal done, they created this golden share thing where the U.S. government could say veto to like moving the headquarters away from Pittsburgh to Tokyo. Like that would be something that Trump could veto, or the closing of factories, or these sorts of things, could all be vetoed by the U.S. government. But just looking at these companies, like Intel is up 46.6% since the deal was announced. MP Materials up 73% since the deal was announced. Um, The lithium company LAC is up 150%, not since the deal went through, but there were some rumors and discussion about the deal. So basically, once it became news that this was happening, it's up 150%. And Trilogy, which trades on the New York Stock Exchange under ticker TMQ, is up 160% since October 6th. So that was just this week. So it is very interesting that this is happening. And, some of these companies, like Trump had been talking about Intel for months
Mhm.
before that deal came out. Like they are talking about the companies that they think are important. And so, the other companies that they have talked about have been the defense contractors like Lockheed Martin. And I know Howard Lutnick has specifically mentioned Lockheed Martin before. So, there's a clear pattern here that the US government is taking stakes in companies they consider to be critical to national defense. And yeah, that's one that they have uttered out loud. So I think for people who are interested in playing this trend, that's something you should look at. But I want to go back to MP Materials because the stock is actually if it's not at all-time highs today, it's touched its all-time high in the last month or so. And it's up to $78 from a high in 2022. That was the last time MP Materials was up this high. That made sense because back in 2022, the company had much, much higher revenues. It had profits. The company has really been kind of flatlined since mid 2023 and has actually been losing money since then as well. Back in 2022, the price of rare earths, and I have the price charts for, and I know that you have practiced these, so correct me if I'm wrong, but
Mhm.
praseodymium oxide and neodymium oxide,
You
which
nailed it. You nailed it.
those are the two I think biggest materials produced by MP Materials. I mean, if you look at those charts, you can see they were much, much higher in price in 2022, and we've just now started to tick up in price. We're still just barely over $100 on neodymium, and it reached as high as almost $350 back in 2021, 2022. So the company itself, the fundamentals of it have not really backed up this run. But it doesn't matter when the US government is saying they're going to take a stake in it. But certainly, if these export controls go into effect, there is an argument to be made that you're going to have just sort of the fervor of it being one of this group of Trump stocks, but also the fundamentals of the company improving vastly. So I think that's just a pretty interesting company right now. Certainly, it's not profitable. It's highly speculative. Um, but we will see what happens there.
Fiscal AI is the fastest growing stock research terminal on the internet. They combine a modern user experience with complete financial data on all stocks globally. Not only does that include 20 years of standard financial statements, but they also track company specific segments and KPIs on over 2,000 companies.
That's right, Jack. Want Amazon's cloud revenue? They've got it. How about Spotify's premium subscribers or segmental analysis of the different luxury verticals at Hermes? This is data that other platforms just don't track, even though it's the data that really matters. They've got all of that and literally millions more data points. And unlike legacy equity research platforms, Fiscal AI's data is real time, so it's updated within minutes of company earnings reports.
And Max, there are so many more features, including earnings calls, transcripts, financial modeling, best in class charting, portfolios of super investors like Stan Druckenmiller and Chris Hone, and they even have an easy to use data API so you can export data and build your own models in Excel. Fiscal AI is changing the way investors conduct equity research, whether it's individuals like us or institutional investors like Van Eck, who have their whole research team on the platform. But don't just take our word for it. Sign up for a 2-week free trial at fiscal.ai/mm to see for yourself. And if you upgrade, our link will get you 15% off your first year on any of their paid tiers. Again, that's fiscal.ai/mm. Let's get back to the interview. Yeah, and you know, like there was a Charlie Munger quote. The great Becky Quick asked him about Uber's IPO, and his response was, "There is a great deal of things that I don't think about that, and one of them is companies that just went public that are losing $1 billion a year." And Uber actually kind of looks interesting now, but it was not Uber was to invest in Uber at the IPO was not a good investment. I think that if people want to chase uh stock stocks that are going to be owned by the US government. I suppose if they're smart and maybe with a little bit of luck and they do a lot of work, they could be successful. Or maybe they're not smart and they're just really lucky. They could, very volatile returns, which if you're a gambler. But I uh, I think that there are a lot of natural resource plays that look, maybe they could work, and maybe this is a weakness of mine as an investor, that just because I'm not excited about it, I'm not going to invest in it, and then that's the thing that makes money. But like natural resource investing, I really like the royalty model because they don't put up capital. And in the short term, if these commodities go up, these companies are going to make a lot of money. And then you're going to see people on the podcast saying, oh my God, this company trades at 4 times earnings or 5 times earnings. The same way in 2022, all these horrible oil companies, people said, this oil company you've never heard of, not ExxonMobil, is trading at 4 times cash flow. It wasn't. It wasn't trading at 4 times cash flow. If you normalize it, and the trend for for squeezes in commodity things is for supply to meet the demand. No, I talked about silver, last week. I think that could be slightly different because most of silver production comes from the other mines, non-silver mines.
Yeah,
It's a byproduct. Go ahead.
but Jack, as we said, these, I mean, it's interesting because like Trilogy Metals, like I went to look at what they do. Like they do copper, they have some cobalt, they have some gold. Like why
They don't.
that?
First of all, they don't do it. They have those assets, and they're going to have to invest a lot of capital expenditure. They are not a producing asset. And I've been an investor in MP Materials and in Trilogy Metals. I think Paulson, the hedge fund, was an investor in that. So I kind of was following the smart money there. And look, I got out too early, clearly. So maybe I'm just kind
Well,
of
my point
butthurt.
being, like,
But
I don't necessarily like MP Materials is like pretty much an exclusive producer of rare earths here in the US. Like it is in a league all of its own. Like how many copper, cobalt, I
yeah,
mean, I know cobalt is a little bit more rare, but like how many copper mines are out there in Canada? How many gold mines are out there in Canada? How many silver mines are out there in Canada? Like some of these things, and people have said like too, like Intel, like if you really care about the semiconductor, advanced semiconductor, like they're certainly not at the cutting edge. Like is that really the company that the US government is going to use to take us to the promised land of having the best AI to defeat?
Yeah, well, Max, to be fair, to kind of defend this thing, first of all, I'm not a. There are a lot of people who are conservative, so they're Trump supporters, but they also have this raging obsession with the free market, and anything that the government gets involved with, they automatically hate. They're in a tough position because their principles would make them criticize the current administrations, but they obviously don't want to do that. I'm not in that position. I've never had that. Uh, you know, thing. Oh my God, this Trump taking 10% stake in Intel is not to me some uh, sacrilege. And I think actually, if you're going to do that, like Intel is the best shot. Why? Because TSM, Taiwan Semiconductor, is not in America. And I mean, if you talk about actual fabrication of chips, yeah, Intel is the biggest American company. And I think, yeah, the rare earth thing also makes sense. And I know, and I'm not up to date on this. I know that even when I did the interview, uh, MP Materials was producing rare earths from its mine. The real thing was the processing, and they were, I think, in maybe stage 1.5, and they were looking towards something they called stage 3 of actually processing it. And China has the technology to process it. I know that was a very high capital expenditure thing. I don't know if they've actually done it, or they're partway, or they've fully done it, or haven't done it at all. This is a thing in mining and metals, is that it takes a lot of capital expenditure. And even if you say, oh my God, they're going to make $20 billion, not MP, but just some giant mining company, often they have to spend, $8 billion a year in capital expenditure, and then they depreciate. That's a depreciation expense every single year. And the royalty companies don't have that. So the royalty companies look expensive, but I think that they actually are cheaper than a lot of these resource stocks. That when the price goes up, these things look like they're at 5 times earnings, but they're really not.
I'm more talking about like you cannot get exposure. Like and this is somewhat like as a gag, like in homage to the great article from Tracy Alloway where she tried to like take delivery of a physical barrel of oil. Like I just want to see like how taken seriously I am by these people. But I did find a place where you can buy uh neodymium oxide, and So I put in for a quote. So we'll see whether we can get some physical neodymium at these low prices at $100, compared to the high before of close to 350. Like, will they sell it to me? How much do I have to buy? Like, is it gonna, like, if in the Tracy Alloway article they were like, do not get a barrel of oil delivered to your apartment because the fumes will kill you in a 400 square foot apartment.
Yeah.
So I don't know if I'm going to get the same information or if they'll even take my call, but my point was less about like whether it's producing or not. Like, I'm more saying that MP Materials is at least like clearly a critical producer
Yeah.
of these minerals, whereas it remains to be seen whether like this lithium company is so critical, whether Trilogy Metals is critical, or there were just entrenched interests that said, if you're gonna buy a copper mine, why don't you buy this one? Or if you're gonna buy a lithium
Yeah.
producer, why don't you buy this one? MP is the only game in town.
Yeah, of scale that's publicly traded. Yeah, I just a word of caution that a big lithium. There's a huge lithium boom in 2021 and maybe 2022, and so these companies were very profitable. Obviously, Albemarle is a big one. I own that. I think I got out of it probably at a modest profit. Like Piedmont Lithium was this company that you'd always see people on Twitter post about. I don't know if Piedmont Lithium is still trading, but I think if you invested in Piedmont Lithium when everyone was talking about Piedmont Lithium, you would be sorely disappointed. I'll also say, I loved that interview with Jim Latinsky, CEO of MP Materials. He seemed like a very capable guy. Um, and I mean, I actually kind of am definitely impressed by his investing. He used to be a hedge fund manager. His investing acumen, his operational acumen. I think Jim Cramer, when he interviews CEOs, is he's not pretending to be impressed when he's by all these CEOs. He is impressed, and he should be impressed. Like, these are impressive people. That doesn't necessarily mean that 2-3 years later the operations is going to be as impressive, or that the stock price will be as impressive. I'll also say China has been threatening this rare earth thing for a while. Like 4 months ago, 5 months ago, I looked into this notice that they put out about what was banned specifically from rare earths. It was yttrium, it was other rare earths that I forget. I remember specifically NdPr, neodymium, praseodymium, was not one of them. And MP Materials produces NdPr, and its other its other byproducts it's produced is not NdPr is what MP makes mostly. So again, the speculation that just because other rare earths are banned doesn't means that NdPr will be banned, meaning that NdPr price is going to go up, meaning MP Materials is going to do well, meaning people should buy MP Materials. It doesn't necessarily focus that. Now, people may say, Jack, you don't know what you're talking about. You don't have the details. I'll say there are probably people watching this right now, or people not watching this right now, who are thinking about buying MP Materials, who know even less than what I'm talking about. So make sure you know enough to prove me wrong and say, Jack, you're a dunce before kind of getting involved. That's my advice. People can do obviously whatever they want, but just my thoughts, Max. Just my thoughts.
Yeah, and I would add on that the some of the metals that were restricted, some of the minerals that were restricted this week were in addition to restrictions they had put out earlier this week. So I think it was 6 that they did this week, and then there were a bunch that had come out earlier in the month. So if you just looked at the ones that were added, they might have already put those ones on the list. I'm not sure. I don't have the full list. And just so you know, Piedmont Lithium, I don't believe trades anymore. It was merged in September, just a few weeks ago, down from a high in 2022 of $75. It looks like it was merged at like $10 or something like that,
There we go.
$7. Yeah, so not great. As well, it ended up on the radar of some short sellers that I know, the guys over at Blue Orca. There are a number of lithium stocks that ended up on those short seller reports. So just and it dropped, it came back up, but what do you know? At the end of the day, it was bought out or merged for 90% of what the share price was. So yeah, pay attention when
Yeah,
short sellers come around.
yeah, short sellers are often right on the fundamentals, and slightly less often, but still often right on the stock price. So I just looked it up on Gemini. There were 7 ones that were put in place, export restrictions in April 2025. Neodymium, praseodymium, not one of them. There were 5 additional rare earths put on in October this month, also not neodymium, praseodymium. So I guess maybe there's speculation that MP Materials, that NdPr will be banned, or that MP Materials is going to be producing a much higher quantities of other non NdPr things. But my point is, like, the details.
It's just a factor. It's just a factor. It's just the rare earth company. There's one rare earth
Yeah,
company that is not totally bullshit that you can trade, that you could dump money into on this news
Yeah.
event. Like that's all it is. It has nothing to do with the price of that thing. But I would argue maybe um that the prices of these minerals might be correlated.
Yeah, they probably are correlated. Yeah.
So, well, Jack, let's turn to the other big thing that has been moving markets over the last year, not just the last month, last few days, and that is the circular financing in AI. I know you also dove into that today.
That's right, Max. Now, this accusation that the AI capital expenditure boom, which I've been public that I'm a believer in, because I see the evidence right before my eyes. The accusations had that this AI capex boom had been dependent on circular financing and basically round tripping, or Nvidia basically investing in companies that then would buy Nvidia products. That accusation has gone back for over a year, with Nvidia being an investor in CoreWeave, which is a big Nvidia customer, as well as other companies. But that really came to the foray when Nvidia partnered with OpenAI. Uh, Nvidia investing $100 billion in OpenAI in order to basically deploy more GPUs, which basically means buying more Nvidia products. So Nvidia is investing in OpenAI, kind of giving OpenAI money in exchange for equity, so that OpenAI has the money to buy more Nvidia chips. Uh, that is, I guess that is a circle, and it is financing. So it is kind of circular financing. Does it compare to the circular financing of 1999? Now, I've only read one book about this, but I have read that book 7 times. So does that count? I guess as reading 7 books. I don't know, but I'll just say that the second deal is AMD, Nvidia's competitor, that is far behind Nvidia, but many people say could
What is
catch
the
up.
book, Jack? You can't drop. I've read the book 7 times and not name it.
Okay. It's called Smartest Guys in the Room. It's about Enron, by Bethany McLean, who I've interviewed. I'll get into that point later, Max. But AMD also issued a warrant, which is basically like a dilutive call option to OpenAI, for 160 million shares, to vest over time as milestones are met, so that OpenAI can buy a lot of AMD chips. So OpenAI and AMD, of course, prices stock soared. So OpenAI kind of made the money back immediately. Max, the point about 99 was a lot of these products, the circular financing then was, I'm a telecom company, you're a telecom company. I buy your fiber. You immediately use that money to buy back my fiber. That was called fiber swaps. So that really, it was fraudulent to refer to that as a purchase, because uh, no money was really exchanging hands. This is, OpenAI is using real money to buy Nvidia chips, or it's going to, almost certainly, that it's going to receive from Nvidia. In exchange, Nvidia gets equity in OpenAI. Now, I happen to be far more bullish on Nvidia than OpenAI. I'm a believer in the picks and shovels rather than actually doing the mining. However, maybe OpenAI, is worth the $500 billion that it's currently supposedly worth. Maybe it's worth more. So I think those are slightly different. And yeah, I also think, Max, that basically, let's say it is. Let's say that these circular financing, it's basically like using steroids, right? It's basically like cheating. There's this in a cycle. You get the cheating phase of when you do steroids, then we get really strong, and then you get the side effects that we we won't mention here. But like, all of these bears who've been so wrong on Nvidia and the semiconductors and the OpenAI capex, like, they've been calling it a fraud for like a year. Like, really, if I thought it was a fraud, I would be more bullish than bearish, because clearly, like, you're saying there's this mechanism where the amount of financing can be, basically, you can print money from thin air in order to create more money to buy GPUs that everyone wants to buy. Like, that seems like a short term catalyst for growth rather than contraction. Even if ultimately it does end in tears. Now, I'm open to the argument that it ends in tears in 18 months or 36 months, but to me, it seems like pretty clear that direction, and that direction is up and higher. And I'm referring to demand for GPUs, and that ultimately will lead to up and higher for revenues and profits. Now, whether it leads to up and higher for share prices is a different story, but it has so far.
So for me, like I've been thinking about this as well, and where will we know? When will we know? And what are the types of things that you might see that say, okay, this circular financing, it's not that the chips aren't being bought and then the use of the GPUs isn't being sold out. The question is the demand going to be there, right? And then also, will the chips last long enough to be what people want to use? Like in 2 years from now, are there going to be more advanced chips that people are going to want to use, and your data center that you built is obsolete, and thus you need to build a new data center because that one is done? Or is the data center, that people have talked about the depreciation, that
Yeah.
that people are depreciating over, say, like 10 years, when really they are depreciating much faster than that. So my question is going to be, like, when are the data centers going to become obsolete? Like, that is going to take a while to see that, or as well to see, is the demand not really going to match the capital expenditure? You're not going to get a return on invested capital. Like, that is something that we will see, but we're not going to see it tomorrow. Probably not going to see it in December. Probably not even going to see it in Q1, right? So it's going to be a while before we're really going to have the rubber hit the road, and it's essentially going to require one of these people who, the last time we talked, we said Jeff Bezos called it like a virtuous bubble,
Mhm.
and some of these things. So it's going to take one of those guys basically coming out and being like, yeah, we don't buy it anymore. We changed our mind. Or you're going to have to wait until the fundamentals actually tell you the answer to whether this capital investment has been um, malinvestment, and that's going to take a while.
Yeah, and I'm going to be, it's going to have to take a Jeff Bezos or a leader, a deployer of capital on a massive scale, certainly Sam Altman, to exhibit a little bit of caution uh, before I change my view that the capital expenditure is just going to, continue sky high over the next year or so. Again, this is like a moving target. I said last week, I said I'm so fantastically bullish, but I can change my view instantly. I don't think I really changed my view that much. I changed my positioning a lot more just because I just realized how long I was, and it was much more safe and prudent for me to cut my exposures. It was painful to do so, and I also, I bought a few puts as well, just because. Uh, I just it's just insane how much money I lost today. So I'm trying to prevent that, but that doesn't fundamentally change my view on AI. I do think, Max, this China thing. So we know someone, I won't mention his name, but he told me, with close ties to the administration, that basically all these smart people around Trump who are economists, who I interviewed Brad Setzer, advisor to the U.S. Trade Representative under Biden, basically the Republican versions of Brad Setzers, let's call them, the Brad Setzers in the Trump administration, the smart people, the technocrats, kind of, if you will, on trade. They almost all of them basically have a view on trade, on tariffs, which is their advice, which is, Mr. President, here's what we recommend: moderate tariffs on the rest of the world. Like with Brazil, for example, they are, we have a surplus with them. We don't need to go so hard on Brazil, or India or Europe, but on China, and to a lesser extent Southeast Asian countries like Vietnam that have a massive surplus with us. So according to Trump, would be treating us very unfairly. Maybe that's true, maybe it's not. But focus on them. So basically, ring fence China. If you're an owner of Chinese stocks as an American, this would not be good. If President Trump listened to the technocrats and the mandarins, pun intended, of his administration, basically focus the tariff energy on China. What I've been hearing, what you've been hearing, and what we've been seeing is that actually Trump has been directing the tariff energy and the focus of the Eye of Sauron, if you will, all around the world. And actually, if anything, he's been kind of easier on China than I expected, and many other people expected, seeing him on Liberation Day. And certainly that's been reflected in the Chinese equity market. So look, it's been no secret, Max, that I've been a massive bull on the Chinese equity market, and that's part of the uh, semis in China, two of my largest positions, and those just absolutely took it on the chin today. So that's why today was a very negative day for me in the market. But I do still think that uh, the Republican Brad Setzers will not be listened to, and that Trump's instinct is to kind of go easy on China.
I think that brings up, like, even talking about the like that group of five stocks that have been bought by the president, like or bought by the U.S. government. like it is very much a play the man, like not play the fundamentals
Yeah.
market right now. Like the question is, are one of these leaders of big tech going to moderate or issue a warning of caution that they're slowing down? Is Trump going to follow through with tariffs on China or with the rest of the world? If it's the rest of the world, you know, it's not super impactful. Like, one of our clients on the fund marketing side specializes in India, and they wrote a piece talking about like, okay, like Indian tariffs are some of the highest. He's really picking on India these last few months. Like, let's look into it. Like, how much does India actually ship to the United States in terms of goods? And like, it really wasn't that much. And that's part of the reason he went for the H-1B visa thing. It's like what they really export is workers and services and talent. And so it's like, okay, these tariffs to India are really not super impactful on the Indian economy. It's such a small part of it. But for China, it's a much bigger deal.
Right, and I actually did interview Brad Setzer recently, trade expert, specialist on balance of payments, so not just flows of goods and services, but of capital flows as well. And he did give that critique. I mean, number one, he said he was a bigger hawk on China than President Trump is. I guess before the tweet today heard around the world, the True Social heard around the world, and basically he says China is cheating at its currency and it's manipulating its currency lower. So Trump should put a lot of pressure on China to strengthen its currency, so weaken the dollar and make Chinese exports less competitive, make U.S. exports more competitive. And he also, echoed that advice of really the great um, you know trade criminal is of the globe is China, like and the rest of the world. So for the President Trump to go so hard against Brazil and go so hard against Europe and the UK, when in many of these instances, we're not being treated unfairly on trade because we literally have a surplus with them. In the case of the UK and Australia and Brazil, but President Trump has gone very, very hard on them, and I think we had a 50% tariff rate on Brazil, very high. I actually don't know if it's still that high, but many people speculate, myself included, like if Jair Bolsonaro, the right wing politician in Brazil, was still in charge, maybe Trump would go easier on him. Maybe he's going hard on Trump because he doesn't like the socialist Brazilian thing. So this is a point again. I've been so wrong on tariffs, so much this year. But one thing I did get right is that President Trump has non-economic motives for tariffs as well as economic tariffs. And you did see he actually kind of got mad at China in his True Social today. One of the reasons was that China was kind of stealing the thunder from this peace deal with Israel and Gaza, which if it goes through, will definitely be a reduction in violence, which will be wonderful for that region. So he has non-economic motives. I will say, my holding. So I won't say. I'll name one stock. Alibaba. I'll even say that I've got $200 calls on Alibaba that are well far out. So I was up, well over 200% on that position alone. Like well over 200%. And so that was a brutal day. I mean, for me today in Alibaba. Fortunately, the calls are longer dated, and maybe on the Delta I got hurt massively, but maybe I got helped modestly because the implied volatility went up. I didn't do the math, and then my Chinese fintechs went down as much. Those could go down like even more. I'm prepared for that emotionally. That's kind of why I raised some cash today. But those names are public, and the Chinese consumer names I have named those. I'm
Well,
very
and
bullish on those.
those are not tariff related in any way. Like, and they trade at such low
Yeah,
valuations, and their ability to do buybacks and issue dividends. Like, if they
yeah,
keep
but
going
now,
down,
now,
like
now,
I'm
Max, now
not.
you're Mr. Fundamentals. Look, I am Mr. Fundamentals, and that everything is true. And even Alibaba's exposure to the U.S., I believe, is less than 10%. But again, look at, I mean, you had a
No, but there
one,
is a
one,
level.
let me finish. You had one True Social post about China, and then Alibaba's down 8%. This huge bull market in Alibaba may be over, at least for now. And Max, you kind of were chiding me for saying, who cares if MP Materials only produces the rare earth that China isn't banning, and China isn't banning NdPr. Yeah, you're right, Max. That my Chinese fintechs are
MP
not fundamentally
Materials
affected.
can't buy
Alibaba
back.
isn't fundamentally affected. But who cares? Who cares? That's my point.
MP Materials can't buy back a third of its stock in a year. That's the difference.
But you were, but so But so you agree that it
Level
matters?
there is a yeah, when a company is trading at 20 times earnings
Yeah,
or
yeah, okay, yeah,
15 times earnings, they can't do the same things that a company that's trading at less than 3 times earnings. If they're like, "Okay, this is absurd. We're turning the buyback machine on." Like, you can do things that other companies can't. Like, there is a level where the
yeah,
fundamentals do matter, and it is pretty close to 2 times earnings.
yeah, yeah. I mean, if these Chinese fintechs go down, give it a little bit of start a Substack. I've been thinking about starting a Substack. Sometimes people want to ask me like, where's your portfolio? Where's your Substack? They go down so small, Max. Who knows? Maybe we'll start a fund. I mean, I think that is often a sign of the top when podcasters launch a fund. The podcast community has been over exposed to these Bitcoin treasury companies, which obviously me, you, and other fundamentally minded folks maybe are a little bit skeptical of. But yeah, Max, I de-risked today. I know you probably were down in the market, but I think down less than me in percentage terms. Did you make any moves?
Yeah, I sold Bitcoin, but
Hmm.
not necessarily because I'm not getting back into Bitcoin, but there are some other like maybe just making a product switch. I'm like, I'm happy to take this risk off over the weekend in Bitcoin because I'm thinking about changing to a new product anyway in how I own it. So that's a little different. Um, let's see. I have re-shorted some of the housing related names, specifically BLDR recently, and I did that via a um, put spread. So that's pretty much it. Nothing huge. Like you, like I'm exposed to those Chinese fintech names, which is part of the reason I was like, there is a difference when things are
Yeah.
trading at such a low valuation that you really can turn on the buyback machine.
But Max, I'm open to the possibility that I'm just a value bro who's diluted. Like how many value investors we know who says this chalk is so cheap it can't go lower, and it always does.
I'm not saying it can't go lower. That's not the
Yeah, yeah.
point. I guess there's just a level where when you have so much cash relative to the price of your stock, like you can just buy so much of it back. You can reduce the share count by not 2%, not 3%. You can reduce it by 30, 50%, like very quickly. And that just has like huge impacts on the share price. And there's plenty of companies that have done that. I think AMR in the energy sector, the coal company, is it's pretty clear that that's what drove the stock price higher. I'm not saying that the same thing is going to happen, but um, based off of the levels of the stock and the fact that they've done the buyback before, the last time they did the buyback on the company, the last time they did a buyback corresponded with a huge run in the stock. So it matters a lot, especially for low float stocks. So it is a relatively low float stock, and if the company decides to become a major buyer, like it's gonna move it.
Yeah, that's true. I feel that way about all the stocks I own, and I kind of had to force myself to sell things because I didn't want to, but I just knew I owned too many stocks, and it was just getting a little bit crazy. So it was more of a risk management exercise rather than a huge thesis change. And I think yeah, we could have some volatility. I'm not much for technical analysis. There are a few people I really like Milton Berg. I really think highly of his technical analysis. But and obviously the pod shop people who it's not lines and charts. They just have computers running all day. They're very good, obviously too. But that the fact that we had to close the market just the stock market drifted lower and lower and lower throughout the day. 3 p.m. no bounce, 3:30 no bounce, and it closed at a low. I forget the technical term for that. That doesn't inspire confidence in me. Any real pullbacks we had this summer, which is basically almost nothing, like the market would go down 60 basis points on some actually kind of bad news, but then the market would close up on the day. So that doesn't inspire a lot of confidence. Yeah, I did buy several Nasdaq puts, and yeah, I guess I kind of tried to realize some losses today, and so I guess like before today, year to date, I was up 60%. And today was a down 8% day to me. So I guess arithmetically, I'm up 52% in the market. Geometrically, which is how things work, it's more like, I guess, a 48%. So today was definitely a big day for me, and not the biggest loss percentage terms, but the biggest loss dollar terms. And so I think, yeah, I just kind of as a risk management exercise had to do it. And that's what I'd again, I don't really give advice, but like I would just say, don't get too crazy out there. Don't believe your own bullish shtick too much. Don't believe your bearish shtick too much. Like I think, if this credit thing gets worse and maybe the high yield bond market starts to trade a little weak as well, then you're going to see more people talk about this Lehman moment in credit. Like take them seriously, but maybe don't. And if some of these business development corps that are actually good, like I think Maine is good, and I bought some today. Maybe take a look at those and be a little bit contrarian. Also, I'll say I still love my precious metal royalty stocks, and even though the price of gold is actually where it was or higher than it was last week, and well higher than it was 2-3 weeks ago, a lot of these precious metals companies like EMX, Wheaton, or Franco-Nevada, which all three of which I own, to be clear, are actually slightly below. So I think in terms of valuation terms, they're not ridiculous at nosebleed levels. And yeah, I also did tactically short gold yesterday, and I closed it today for margin reasons. So I had a modest profit there.
Well, why don't we leave it right there? But before we do you have any closing thoughts for us?
Yeah, watch this credit space. Again, the high yield market has barely budged, and yet in the non-corporate bond world, non-bank world, things are looking very dodgy indeed. Again, I talked about a contrarian play on one of these business development corps. In the stock market, I'd say prepare for some jitters. I definitely am, and if you're wide-eyed bullish, like I was and am, I'd pay a special attention to the bears, because I have I have some concerns, but we'll leave it there. People should remember to check out today's sponsor at fiscal.ai/monetary matters, or fiscal.ai/mm. And people should check out my show, Monetary Matters. I'm going to be interviewing Brad Setzer this weekend, as well as your show, Other People's Money. Thanks. Until next time.
Thank you. Just close the door.